when so much of the economy is intellectual or electronic, or done on a screen, where you don't have to have physical people connecting. You have these systems and ideas connecting, and we've been flat since then, and even flatter since the beginning of the year. No matter how you slice it, on any of those measures, valuations are in the upper end of where they've ever been historically.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're speaking with Senior Portfolio Manager Tom Martin of Globalt Investments based in Atlanta. Tom's a portfolio manager, and it's always a pleasure to be able to talk to someone who's actually managing money through a period like we've experienced in 2025 to 2026. I really enjoyed asking Tom about the challenges of a concentrated benchmark, how the world has changed from a market perspective, from a macro perspective, from a geopolitical perspective, et cetera, from 2025 to 2026. Some key takeaways from earnings season that just wrapped here at the beginning of 2026, and much, much more. So please enjoy this interview with Tom Martin of Globalt Investments. Hey everyone, super excited to be talking today with Tom Martin. Tom's a portfolio manager at Globalt Investments based in Atlanta. Tom, I've heard a lot about you and have followed your work. Super excited to have a conversation and share some of your expertise with our viewers. So thanks for coming on today.
Well, Dave, thanks for having me on your program. I'm excited to be here too.
I feel like our cup runneth over of things we could talk about in 2026. There's so much happening, right, from an investing perspective. If you could, start us off at a high level, just about, what is your perspective given the current market conditions in the equity space? We've had an incredible run in 2025 that appears to have stalled out. Bulls seem kind of flummoxed that the uptrend is not continuing. Bears are, for now, just sort of holding on and waiting for something. The S&P's been sort of flat in 2026. How do you assess the current market condition? What stands out to you as you're trying to evaluate where we're at here?
Sure. Well, I think that, what you said at the beginning, which is that the market had a terrific run up until about October, and we've been flat since then, and even flatter since the beginning of the year for the market as a whole. However, up until October, really, it was a very strongly growth market and not a value market. And a technology-driven Mag 7-ish kind of market. And we've forgotten that because now the Mag 7 has underperformed and tech has underperformed, and the market has gotten a little bit churny kind of on the underneath side. And I think that's the most important place to start, is that market is near all-time highs. And valuation, not just value stocks, which have definitely outperformed during this most recent time period relative to growth. It's been quite a spread, but the idea of valuation and what goes into that, I think, is really coming to the fore. And part of that is just because the market is at a high valuation, and when you get that, to be able to go any further, those valuations have to be sustained by the fundamentals. And the fundamentals for the market as a whole, or for the economy, are still very strong. A fair amount of fiscal stimulus in the pipeline that people are aware of and talking about, as well as the monetary stimulus of already lowered rates. Not to say anything about what we think about the future of rates, but at least they're kind of low now and don't look like they're going to be going higher at any rate. So a fair amount of good underpinnings for the economy as a whole. But this AI, development question, secular theme has, really gone from nowhere a couple of years ago, well, 4 years ago, I guess, more or less, to an acceleration. And the acceleration in the rate of change of perceptions and what it can do and the effects on industries, and particularly the growth rates of those industries, is where we're at right now. And when you get a question about high growth rates, that's where valuation and multiples start to compress and correct a little bit. And I think that's where we're at right now.
That was a fantastic summary, Tom, on so many different things I'd love to dig into a little bit further. You brought up the V word, valuation. So let's dig into that if we could a little bit. In a growth oriented bull market like we experienced in 2025, right? And if you look at market history, valuations often seem pretty high, right? Because you have increased expectations of future growth. You'd mentioned at some point valuations seem, too high, right? They just seem excessive. What are there specific things that you look for, or historical comparisons that allow us or allow you to try to differentiate between valuations that are kind of normal when a new technology is transformative versus valuations that are so obviously extreme that this is going to be a problem? Like what does that look like? And is there a historical comparison or indicator that helps you make that assessment?
Well, there are historical comparisons, and you can look at just the standard indicators, whether it's price to sales, price to book, price to earnings, and you can look at that relative to the current interest rate regime, or to inflation, or to just general thoughts on stability. But no matter how you slice it, on any of those measures, valuations are in the upper end of where they've ever been historically. Now, maybe not at the total extremes that we had a couple of times, but they've approached that, and they're in that territory. Let's just say. I mean, they're not cheap. And is it is it justified? Are things that different now? The thing that is different is that you have this group of companies, and whether it's the Mag 7 or it's a little bit more than that, these massive, massive companies, and you really didn't have this exact situation before. Sure, you had big market leaders and IBM and AT&T and just throughout the ages, big companies, but you didn't have the kind of connectivity and mass market capture by these companies, the communications, the networking effects, the real growth that's there and has been there for years, generating cash flow that is available for investment. And so one of the things you're seeing these days is the sheer ability to invest in opportunities. And that's been a big subject lately, right? Is the CapEx spending of the hyperscalers, and this whole thing with AI and the way that it has sort of built on itself. I mean, economies build on themselves, and that's how you get this ratcheting effect. And when so much of the economy is intellectual or electronic, or done on a screen, where you don't have to have physical people connecting, you have these systems and ideas connecting, and then you kind of get a pullback.
I'm curious. We just came through, first earnings season of 2026 here in January into February. With all of the CapEx, with all of the aggressive spending, let's say on AI, which is a big change from what we've seen previously. Did you hear anything that gives you confidence and/or skepticism that that incredible spending in AI infrastructure generates these profits that I think a lot of AI related plays are sort of waiting for? What did you learn from this earnings season that sort of gives you conviction on one way or another?
Right. So, we are waiting to see if this spending is going to generate a good return on investment. And, we haven't seen the kind of numbers that prove that by any stretch. But we have seen progress in that, and we have seen usage tick up. And we have seen monthly average users, for example, ticking up. And I didn't know that I would necessarily think that we would be applying that metric, which is more of like a Facebook metric, to AI. But of course you do. There's a lot of different ways to use it, but ultimately somebody has to kind of get online and access the system. And so we've seen that, and we have seen revenues increase. It's not enough to support the scale of the investments so far. But does it give confidence that it could be there? I believe that it does. And the use cases and the interconnection of this has started to really, I think, astound people in terms of that it really is here and it really is incredible as opposed to just being hype. I mean, there's a lot of things that are still hype that we're hoping for in the future. I mean, just to say, not that robots are all hype, but robots are hard, and they're harder than agents in AI that can book trips or can create an app. But we have seen some of these things come through, and that is in turn driving the need for the models themselves and the evolution of those models and the way that they work, which still requires a great deal of compute, which in turn requires data centers and energy and all of that kind of stuff. So I believe we're seeing that in a number of different ways. I mentioned a couple of them, but another one is just the price of memory. And so memory, which forever has been a commodity and has been sort of death if you get on the wrong side of the build side. And Micron, didn't want to build any for the longest time, and they finally did. 200 billion in investments in putting up new fabs, and the pricing up 80%. So the demand is real. The demand seems sustainable. So that's the long answer to your question, which is yes.
No, well said, and great evidence and data to back that up, Tom, which I really appreciate. You had mentioned earlier, just it's sort of in passing, about the concentrated benchmark issue that we have in 2026. Certainly a challenge, I would argue, for any active manager trying to figure that out. As a portfolio manager who runs growth portfolios, can you talk a little bit about the challenges that concentrated benchmark has presented? Specifically because we've gone from a year where not owning the Magnificent Seven probably killed your performance to now owning the Magnificent Seven probably killing your performance. It's either absolutely you have to own them or absolutely you can't own them. As a money manager, how do you navigate through that period, and how do you manage that, I guess, concentration risk in the benchmark?
Sure. Well, there are a couple of things. And for the strategies that I'm the lead on, the benchmark is the S&P 500. And, say what you will about it and the fact that you can measure that X number of companies have, 30 or 40% of the weighting of the market cap in the index, and that is to some degree unprecedented, or how much unprecedented is it, and then are there ways to sort of leaven that by looking at the underlying growth metrics that they have and the businesses that they are in and the advantages that they've been able to stay. We also manage a growth strategy that is geared against the Russell 1000 growth. Now, you want to see a concentrated benchmark. There's the Russell 1000 growth is huge. And I don't know, once these concentrations get over a certain amount, I think, the long-term average investor needs to at least be aware, if not to start to kind of diversify away from that. But that being said, the S&P 500, I believe, is still reasonable in terms of the weightings of some of these companies. It used to be back 30 years ago that if you had a individual stock that was 5% or more that was considered a concentration, and a prudent person would not have that kind of a weighting in the portfolio. And if you have a family that's gotten made their fortune through basically having 100% in a company, it's very hard for them to get down to some of those numbers. But certainly a number between 5 and 10% was considered to be a concentration. And now a number of the S&P 5 companies are in that range. And when you add them all up, you get to 35 or 40%. But the businesses that they're in, the growth that they have, the competitive advantages that they have, the cash flows that they generate, you want to be where the value is being created, and they're still creating value and have more opportunity to do that. That being said, and I know I go on for a long time, but I think that I don't feel as though I have to own any of those, because we run a fundamental process, and although we measure risk against the benchmark, we're not afraid to underweight them, and maybe not even own them at all. I think some of the risk there is that these are storied names, and that even when the fundamentals are potentially not up to snuff for a sustainably long enough period of time that you don't want to own them, you run the risk that the market just buys them anyway. And so there's your benchmark when it's not following the fundamentals. So we're very careful at being aware of the index, being aware of what the company's businesses are, where they're succeeding, where they're having issues, and where we want to kind of fade that if we are not thinking that those are businesses that are hitting on all cylinders.
Super helpful, Tom. No, I appreciate that. You'd mentioned, a number of times sort of your fundamental process, right? Which sounds to me, what you're alluding to, I think, sort of a bottom up, let's evaluate these companies and their possibilities type of process. I'm curious what sort of, a lot of our viewers are individual investors, have not worked at a major, money management firm, and aren't familiar with some of the resources you may be using. You don't have to give us all the secret sauce, but I'm curious, are there quantitative methods or models that you tend to incorporate? What does that look like, and how do you balance more quantitative statistical analysis of companies versus kind of the classic Peter Lynch methodology? And follow-up question, has AI inserted itself in your process in some way to speak of?
Right. So there are a number of factors that come to bear on our process. And one of them, one of the first ones, is because we run a global macro strategy as well, which invests in basically all the asset classes. It's long only, and it's expressed with ETFs, but still, it's any kind of stock, pretty much any kind of bond, real estate, cash, alternatives. And we make weightings among those. So we're very attuned to the macro factors that are influencing these things. And of course, those are very difficult to predict. But if you can get them right, they align with some of the larger themes that you see, it directs you to where you want to have more of a weighting and less of a weighting in some of the stocks. So we have that at first to help us with our sector allocations. And we do have a proprietary model that helps us to allocate among those asset classes. But then, I think that I should emphasize to individual investors that, there's so many different ways you can make decisions about stocks in the stock market. But we believe in the end that the fundamentals, in other words, the company's business, that they have end customers that they sell things to, that they have a competitive advantage on, that these end markets have growth rates that are being driven by some secular forces, and that some companies are better positioned, better managed, more experienced to be able to take advantage of that. So we're looking for those things. But as you look at themes and these qualitative things, you need to have some degree of discipline, because nobody loves a good story better than I do. And I think, the every investor, whether institutional, retail, day trader, whatever, you're interested in that story. And I'm interested in the longer term or medium term stories that I think are sustainable. And to get away from sort of the I fell in love with it, dreamy type stuff, I want to see it come through in actual earnings. So it's one thing for a management to say, "Hey, we're doing all these great things, and we made some mistakes before, but by golly, we're fixing those," and that's great. But sometimes they are successful at that, and sometimes they're less successful. And when it comes through in the revenues and the margins and the earnings per share. And so we're looking for those companies that are doing better than their guidance, and that is forcing Wall Street to raise their estimates because they've underestimated that company. And when you see that, then you can go in and start looking for the reasons for that and start having a better way to evaluate in the real world, is this something that has got legs?
Oh, really, really helpful, Tom, and I appreciate that. And thanks for a brief window into how you and a firm like yours at Globalt would apply some of those resources. I'm curious. You've mentioned a number of times earnings, and we've come obviously through this first earnings season. I'm curious how some of the macro themes that we've been I think have so dominated the news flow and everything, from tariffs to inflationary fears to interest rates in the Fed. How have you seen those potential risks, I guess, tailwinds or headwinds, reflected in earnings? And which of those, or a combination of them, stand out as concerns to be focused on here as we get into Q2 very soon?
Well, I'll just highlight one, and that is the focus on physical assets, and on security, whether it is for a sovereign nation or for a company that needs resources. So, ever since COVID, I think there's been a heightened awareness of supply chains and supply chain security, and to be able to get the materials that you need to be able to make your product efficiently, and at the lowest cost possible. And so you had COVID, which messed those up, and was difficult to manage. But companies, they found a way, they managed through. And then tariffs, through another kind of curveball there, or monkey wrench, or whatever you want to call it, it again made it difficult to handle those on top of what was already there. And so now you've seen companies that need things, and countries that need things. And, there are some areas where, one country, let's just say, got to be the producer of that. So rare earths are a prime example of that, and they are rare. They are they're not very big in terms of market capitalization, et cetera. But there are a number of these areas where people let the most efficient way to get it done, and then somebody's got all the control. And so now people are trying to claw that back, and that happens with basic resources, like oil, like chemicals, like other materials that you need. And so we're very aware of that, and a number of the companies that were in these really kind of dirty, smaller businesses, are starting to have their day and to become more important. And so we want to be very aware of that, and make sure that we are taking into account both the risks and the opportunities there.
I'm curious. You've mentioned in your, sort of high level thinking of alternative assets. You mentioned real estate and sort of generally alternatives. Commodities stand out as obviously an area of the market that showed remarkable strength in 2025. Certainly gold and silver, which outpaced both the S&P and the Nasdaq. We're seeing both of those with quite a lot of volatility, gold and silver in particular, and other metals in Q1 of 2026. How do precious metals fit into your thinking, and how should investors be thinking about something like gold, which has outperformed traditionally, though more of a safe haven? How should it fit into our thinking in a portfolio context here?
Yeah, gold, and to a lesser extent silver. Gold has always been the asset that helps in a lot of different scenarios, but can also be flat for a long period of time.
Mm,
I think it's difficult for some investors to think that gold is a real thing until it's all of a sudden it slaps you in the face by being up a great deal and really um, hurting your performance.
mm,
We believe that gold is a real thing. I know that sounds silly because you can hold it in your hand, but it doesn't pay a dividend, it doesn't grow, it doesn't participate in innovation. However, for thousands of years, it has been a truly stable store of value. And whether it is accumulated by dragons or by sovereign countries, central banks, etc., it is an accepted haven of stability that has stood the test of time. And so now you are seeing that asset being accumulated for countries to be able to kind of shore up their credibility. We were, I think, fairly early in our generating a position or building a position in gold and having it as being our major alternative asset. It is one that, for all the quote alternative assets that are out there, it's unique, right? So it's not another grouping of stocks or bonds or derivatives or something else. It's not a hedge fund. It's not long short. It's not multi-strat. It's its own thing, and so it has a low correlation, and that's what you want. I mean, gold and cash are pretty much your alternative asset classes when the market goes down. And that when that became recognized the way it did in 2025, in the beginning part of 2026, that when these things build up and then start bend backwards over on themselves, there needs to be a correction. And of course, it looks like there needs to be a correction all the way up until there finally is. And so now we believe we're in a consolidation phase in both of those, and that may last for a while. Things just they grow to the sky and then they don't anymore. We believe that the fundamental case, the real world case is still there to support it, but its performance relative to other classes may flatten out for some period of time. And honestly, we don't know when that is. We still have exposure, but we trimmed our exposure significantly several times during the run up. So we banked some of that money, so to speak.
mm.
But when we come back to be more aggressive in it, we're going to have to wait to just see how things develop.
I feel like I distinctly remember like 2016, 2017, 2018 kind of period where risk assets are just starting to really emerge, and gold just sitting there nice and sideways for years on end. So it has happened before. I think to your point, Tom. We haven't talked at all about non-U.S. markets. A lot of people, I feel like U.S. based investors were maybe caught off guard by how strong non-U.S. markets performed relative to the S&P and the Nasdaq in 2025. We're seeing more of that in some cases in 2026. How do you think about a non-U.S. allocation, and how should investors? Is that a trade that was sort of a last year trade that's over, or is there anything that gives you confidence that that is maybe just getting started?
Well, it's a great question, and for as you said, years and years, international was not the place to be. You wanted to be in the U.S. And prior to that period of time, way back in the '80s or whatever, it was like you had to be diversified into international markets. I mean,
Yeah.
how could you be so parochial to just be in the United States market? Um, there are a number of things to think about, but simply a very long time of underperformance and what the technicians might call base building has been going on in those markets. And long enough that it has been ripe that, kind of in the beginning of the year, international would outperform, then it would fade. And it did that for several years. Now, it didn't do that last year. Last year, it came back. What was different, I don't really think it was the valuation, although, the valuation gap continued to widen. But some of that valuation gap is based on, growth and exposure to innovation. The United States is the most growthy, innovative market, entrepreneurial market that there is. It's a free economy, and it doesn't have the kinds of regulation or policies that have stymied growth that have been in Europe, as an example. I think some of that started to change when Russia invaded Ukraine, and President Trump said, "Yeah, he didn't say you're on your own, but he said, you need to start spending some money on this stuff," and they did. And so, even though that's one area, the idea that now they're going to spend money on whether it's defense technology or technology in general, and maybe they start to have better all-inclusive energy types of policies, and be more pro-growth. I think that that's a underlying thing that has changed that makes those markets attractive, along with their valuation. We still don't really think we want to be overweight there. We think that where we've taken that money or not put that money there, and we put it in the precious metals, that's been a better trade. So missed out on the international, but made up for it on that side. So it's a question of where what you're going to invest in and where you want to put your money. To the extent that the fundamentals slowly improve in these other areas, we think that is a positive. The strength of the dollar or the non-strength of the dollar lately has been an issue, but maybe that is being a bit overdone. And if the dollar starts to come back, that's going to put a little bit of pressure on these other economies.
Tom, this is a real pleasure to speak with you. I've heard great things about you, and I've enjoyed following your work in financial media. And I really appreciate you giving us some time to talk through some of these concepts today. Thanks so much for coming on the show. I hope we can continue the conversation again down the road. But for now, I say thanks.
Yeah, thank you. And I look forward to talking again.
Really enjoyed picking Tom's brain a bit, talking about how he has been able to manage money successfully through, in some ways one of the easier periods, just this nice consistent bull market in 2025, to arguably a very challenging period with difficult market conditions, with a very concentrated benchmark and with performance dominated by those AI names through much of 2025. Really appreciated his thoughts about the benchmarks, the S&P 500, the Russell 1000 growth. Definitely made me think of my time working for a large money manager, where we would spend an inordinate amount of time dissecting benchmarks, thinking about where we could find opportunities to outperform and how to make sense of what was going on as we evaluated market conditions through the lens of this benchmark that we are trying to outperform. Really appreciated his comments about AI and valuations. I'm enjoying asking those questions of anyone that I can, because I think some different perspectives can be very, very helpful. And he had, I think, some fair points about the differences between sort of healthy, strong valuations in a bull market versus what feels more excessive, and doing that historical comparison to try to evaluate it. Really enjoyed his comments about quantitative methodology, how he thinks about it at a macro level, but also at the single security, what we call a security selection level. For those of you that are more individual investors and don't have much of a quantitative process, hopefully that gives you a little bit of a perspective into how a more of an institutional money manager would use resources and tools that are available to them to better understand the markets from a quantitative perspective. Great comments about gold and precious metals, the reason why gold has held value for so long, but the reality that while gold has had periods of extreme upward trends like we experienced in 2026, it's also been sideways for years at a time and hasn't really changed value a whole lot. And I appreciate him reminding me, because the recency bias has me thinking it's just going to keep going up and up. Great opportunity there to learn from a money manager navigating through these markets. Hopefully that gives you some ideas about how to think about things and where some opportunities could be here as we continue through Q1 of 2026. Thanks again to Tom Martin of Globalt Investments joining me on the show. Hope we can get him back on the show to update on how the markets have changed as we get more data through 2026 on inflation and Fed policy, monetary policy, fiscal policy, all those good things. By the way, he had mentioned briefly about technical analysis and base building. If you want to learn more about the technical tools that a portfolio manager like Tom could apply to better relate the fundamentals to the price action as evidenced by stock market movements. If you want to upgrade your own ability to evaluate those conditions, our Market Misbehavior Premium memberships could be a great opportunity for you to upgrade your own investment process here in 2026 and beyond. 3 great benefits to the premium membership: virtual courses on behavioral finance, technical analysis, and much more. Premium member-only reports like our weekly flight plan, our monthly chart review. Finally, access to our member community where you can ask questions, where you can learn from other like-minded investors, and have me sharing ideas, tips, and tricks all along the way as we navigate these markets together. If that seems interesting to you, we'd love to have you on the inside. Go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Hey, if you have any suggestions of other guests we could bring on the Market Misbehavior podcast, let me know. You can contact us on our YouTube channel. Use the comments section on our most recent video. We'll look for your suggestions and look forward to chasing down some awesome new guests for the show. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts.